Hey guys, what's going on? In this video, I'm going to talk about Greek options and how they affect you in your trade. So I'm basically just going to make this a more simplified version of all of this, because really in the end, a lot of this is just kind of boring, but you still need to know it. So first off, let's start with your layout. So if you're using TD Ameritrade, the Thinkorswim platform, you'll come up here to layout and you'll click on that, and if you have the default settings, it could be right there. Just click it and add it. But if you don't, just click customize and you'll just type it in up there and add them, and there you go. So I normally don't have all of these, but for this video I went ahead and added everything just so I can just show you. So let's start off with Theta. So Theta is basically a measurement of time, technically time decay. So if you are taking we'll start with the calls. If you're taking a long position with calls, so you buy something right here on the ask, and as this contract approaches the expiration, Theta goes against you, especially if you are out of the money. So if you're down here in this black area, Theta goes against you hard. Now, the same is true over here if you're taking a long position for the puts. The closer it gets to expiration, the worse Theta becomes. So let's go back here. If you're taking a short position with the calls, so the bid, or the puts, the bid over here as well, Theta actually is in your favor, because with these contracts right here, the closer, if you're selling this, and in my last video, I actually explained the difference between all of these. So if you don't know what I'm talking about, you should probably go and watch that video. So anyways, if you're selling these contracts right here, so you're a contract writer, you're selling them, and as this gets closer to expiration, you actually benefit by these contracts technically losing more money. And that's not you losing money, that is the people who are on the long side, they are losing the money. So you're buying up here and you're covering down here, you make the difference. So that's how that works. So let's take a quick look at Theta. Here we are for Theta, and as you can see right here, Theta is not too bad. It's only minus 5 cents. But then it goes 10 and then higher, and it hits minus 20 cents and then it starts going down. So at this point you may be thinking, why is it going down? That looks like a better value for Theta. It's not that bad down here at 4 cents. Well, the thing is, if you come over here and look at the price, this contract is selling at 13 cents. So 13 times 100, because each contract controls 100 shares, it's only a value of $13. So there's only so much money you can pull out of something that's worthless, versus going up here to where this is going for $3.55, and you got a Theta for minus 20 cents. You can pull a lot more out of more money. So that's pretty obvious. Now if you go over here and look at the puts, it's the same thing. So the Theta, as you start to get out, it gets worse because your values are dropping. Now if you're looking right here, reason why Theta is so high is because, you know, this ticker right here is uptrending at this moment. So this ticker is uptrending, so it puts a lot of Theta on the side of the puts, because with puts, you know, you want the price to go down. So if the price is going up over here, then obviously the people over here in the long positions, they're losing money. So then Theta goes up. So that's how that works. You know, I'm gonna hit the other three, but if you want to learn more about this, you know, do some research. I mean, you can get more in depth on all of them, but really at the end of the day, you just need to know what they do and how they affect you in your trades. So next we're going to talk about the delta. So here we have delta, and basically delta measures the direction for the amount of money that you will make for every dollar that this stock either moves up or down. So just to simplify this and keep this short, we'll talk about the call side, you know, because it holds true over here, and I'll just continue to be redundant. So here we are with the delta. So we'll just look at right here, 0.62, so 62 cents is the delta. So for this ticker right now, it's now priced at $149.29. If this goes up to $150.29, it moves up $1, obviously, and so you will make that difference of 62 cents on your contract. So as you start seeing this go deeper into the money, as it starts moving, you know, in dollars, you start making a lot more money. And so let's just say you get in right here, and then it makes $1. So then it goes up here to this next level, and you know, now right there you just made that much money. So then it goes up one more $1. Now you just made that much money, and so on. So that's how it works. Now on the flip side of that, if the value drops $1 and it starts, you know, going down, especially once it gets out of the money, you can see the difference and how much you actually lose. You know, I ain't saying that you're gonna lose like 17 cents. No, that's when you come from here to here, that's the difference you lost in everything, and that is drastic, so bad. So you know, you have to keep an eye on your delta, and the delta actually kind of, in a sense, acts almost like a probability. So a lot of people like to trade deltas that are, you know, 0.70, and basically the reason why they're doing that is, if you look at this strike price right here, $148. So this is basically saying that by February the 1st, that roughly there's a 72% chance that it will stay in the money. So that's how a lot of people kind of trade this as well. So moving on to the next one, gamma. So with gamma, it's basically the measurement of acceleration. So for instance, if you look right here, this first level. You know, this contract is at the money, and you look at the gamma, you see all these 4 cents for gamma. Now, for every dollar that, you know, going back to the delta real quick, for every dollar that this increases or decreases, you know, that's how your position adjusts with its price. So this is technically like how much. Over here is basically, you know, how quickly, I hope this makes sense, but like how quickly that this is going to happen. So if you look right here at this first contract that is out of the money, now because it's out of the money, it is going to be cheaper, and let's just say that this ends up going, you know, in the money. Now when you're hanging out around this area right here at the money, the gamma it's going to be its greatest at this point, and as it gets further away from this at the money point, it, you know, it decreases. So let's just say you buy this contract, this first one out the money, and you just know, for whatever reason, you just know that this price of this stock is going to go up. So you get in here and it goes up. So the percentage wise of, you know, of how much you make, you know, it I guess that, you know, like, I guess the best way to say it is it accelerates the, you know, the rate of money that you get. You know, it's kind of hard to explain, honestly. And the mathematical formula is crazy. I mean, they have calculators that can, you know, compute it and whatnot, but there's no need for that when, you know, the system just tells you what it is. But honestly, there's, you know, just know what this is about. I mean, personally, I don't even keep gamma up. I mean, it really doesn't matter to me at all, especially since I'm a momentum trader. I mean, I know if I'm trading on momentum, if the momentum is going in my favor, I'm going to make money quick. If it's going against me, I'm going to lose money quick. So that's what I focus on. And at that point, really, gamma is the least of my cares. So going back to this, you can see as we get further deep into money, it goes to zero. And you can also look at the difference. So we'll just talk about this one right here. So 1305, and then it goes up to 1380. But if you look down here, let's see, we'll go right here. So you have $3.55, and then jumps up to $4.70, then $4.25, and you know, the values grow quicker, and then the values kind of slow down. You know, I guess that's kind of the best way to put it, on adding more and more money. And you know, on the opposite side of it, the further you get away, you know, your gamma, it just drops pretty much to nothing. So that's pretty much, you know, gamma for you. So the next one, let's see, we did theta, delta, gamma, so Vega. So Vega is pretty much the, you know, volatility in your trade. So with Vega increases with each percentage point of the implied volatility. So when you hear people talking about, you know, the IV in options, that's what they're talking about, is the implied volatility. So if you look, you can see the Vega, you know, these figures right here, and as these percentage points change, as this goes down in value, you can see the Vega, increasing right there, and then it starts, breaking back down as it just gets so far out of the money. So, that's basically what, that's not basically, that's exactly what, Vega is. It's just a measurement for, the volatility. And, again, when the percentage changes in the IV, that's how, for every dollar that it changes, that percentage in the IV changes, and so for, your IV changes as well. So this is a simplified version for the Greek options, and you can do more research on it. It just depends on how you trade and what you're looking to get out of this. For me, because I am a momentum trader, I honestly like to have the Theta up. Delta matters, and the reason why I don't really throw up the Gamma or Vega is, one, the volatility. From momentum trading, I already know that there's volatility. That's what I trade. So I don't need this in my trades because I already know it's going to be volatile. The Gamma just doesn't matter to me. Now Delta, does matter to an extent, but with the way I trade, I pretty much hit decent deltas anyways. So that's why I don't even add that. But I always keep Theta up, just because since I trade the long calls and puts, and Theta is not your friend when you're on that side of the trade. So I hope this video helps you out, helps you understand it a little bit. And there really wasn't a need to really make this video any longer than what it is. But if you feel inclined to, I guess, really study it, have fun. So I appreciate you guys watching this video in this course. And if you haven't yet, please subscribe, click that notification button so you can get these videos as they upload. And also, if you're on Facebook, check out the Facebook group Transparent Traders. The link will be down below in the description. It actually be right under the description, and join. So again, I appreciate you taking your time to watch this video, and I will see you in the next one.